In a thought-provoking New York Times essay responding to President Biden's recent trade restrictions on China, former Obama administration official Stephen Ratner made an impassioned plea for the United States to return to a global system based on the principle of comparative advantage. Ratner, along with many other mainstream economists and officials, argues that tariffs and protectionist trade policies violate this bedrock economic principle, and that the American consumer is ultimately better off when they have access to the cheapest foreign products available in the global marketplace. On its face, the theory is elegant in its simplicity and persuasive in its conclusions. Comparative advantage, which has been the lodestar of international trade theory since it was first articulated by economist David Ricardo in 1817, proposes that the global economy functions optimally when different countries specialize in producing the goods and services in which they have a relative productivity advantage. Even if one country can produce everything more efficiently than another in absolute terms, both nations will still be better off if they each focus on their areas of comparative strength and then freely trade with one another. To illustrate how comparative advantage works in practice, let's consider the classic economics 101 example of a simplified world consisting of two countries, Germany and Spain, which each produce two goods, textiles and glass. Even if we assume that German industry is more productive and can manufacture both textiles and glass at lower costs than their Spanish counterparts, Germany will still only have a comparative advantage in one of the two products. If Germany's price edge is greater in textiles than in glass, then its comparative advantage lies in textile production, while Spain's comparative strength is in glassmaking. In this scenario, the theory tells us, it is mutually beneficial for Germany to concentrate its resources on churning out textiles, while Spain does the same with glass. The two countries can then trade with each other, exchanging the fruits of their specialized labor in the global marketplace. Doing so, Ricardo mathematically demonstrated, allows both economies to collectively generate more output and achieve a higher standard of living than if they each tried to produce both goods for themselves. It's a compelling framework, and one that has shaped the modern global trading system. But as Ratner's critics point out, the real world doesn't neatly conform to the tidy assumptions of Ricardo's model. The comparative advantage theory, they argue, only holds true if trade between nations is relatively balanced over time. The exchange part of the equation is key, merely enabling countries to specialize in certain industries and sell their wares globally doesn't guarantee that the welfare gains Ricardo described will actually materialize. Those reciprocal benefits are only realized when trading partners buy from each other in roughly equal measure, ensuring a balanced flow of goods, services, and capital across borders. The problem, as heterodox economists and trade skeptics see it, is that this relative balance has been sorely lacking from the global trading environment in recent decades. Instead of an orderly and equitable system of international give and take, world commerce has become defined by stark and persistent imbalances, with some countries racking up huge trade surpluses and foreign exchange reserves year after year, while others are left drowning in chronic deficits and debt. Rather than harmonious cooperation, the skeptics argue, this lopsided dynamic begins to look more like cutthroat competition or even economic warfare, a zero-sum battle for market share and geopolitical dominance in which the gains of the victors are achieved at the expense of the losers. These arguments, once considered fringe in mainstream economic circles, have gained steam in recent years as global trading relationships have frayed and nationalist sentiment has risen around the world. Looking at the data, it's not hard to see why. Anyone who has even casually followed international economics news over the past couple decades is familiar with the broad contours: China's meteoric economic rise, fueled by a mercantilist development model geared toward export-led growth, the dramatic expansion of transnational supply chains, with Western companies eagerly offshoring production to lower-wage countries, the emergence of huge and persistent U.S. trade deficits, particularly with China, and the decimation of the American manufacturing sector, as once thriving industrial towns across the heartland fell into destitution and despair. The tectonic geopolitical shifts unleashed by these developments are still playing out in real time. But with the benefit of hindsight, it is evident that the trading system that evolved in recent decades diverged quite dramatically from the comparative advantage ideal. To return to our simplified example of Germany and Spain, the theory tells us that Teutonic efficiency will translate into comparatively lower prices for, say, textiles than glass in international markets. Germany specializes in exporting textiles while running glass trade deficits with Spain. Over time, these sectoral imbalances are supposed to even out. Comparative Advantage predicts that Germany will have a surplus in textiles and Spain a surplus in glass, with the value of the two countries' respective exports matching up. But suppose Germany's vaunted industrial prowess allows it to churn out not just textiles, but also glass at lower price points than Spanish producers can. According to the comparative advantage theory, this shouldn't be possible. If Germany can make everything cheaper, then it has no comparative productivity edge at all. Yet what if German wage growth lags so far behind gains in productivity that it's able to profitably undercut rivals in both industries? In this scenario, Germany could flood the global markets with its glass and textiles, while its own underpaid workers lack sufficient purchasing power to buy imports from Spain or anywhere else. The result would be a persistent German trade surplus, as Berlin hoovers up global market share at the expense of other countries' workers and manufacturers. This dynamic, the critics contend, is not comparative advantage at all, it's a beggar-thy-neighbor race to the bottom. And it's exactly what we saw play out on the global stage in the years leading up to the 2008 financial crisis, as China, Germany and other surplus countries pursued export-oriented growth models, while the US and other deficit nations borrowed profligately to finance consumption. For a time, this system puttered along. Cheap capital generated by China, Germany, Japan and the oil states flowed into the US and peripheral Europe, fueling debt-driven consumption and a series of asset bubbles. The gaping U.S. current account deficit, which averaged over 5% of GDP in the 5 years preceding the crisis, acted as a crucial source of demand for the world's exporters. But it was a fragile equilibrium. When the music finally stopped and the financial engineering unraveled in 2008, the structural inadequacies and dangers of this askew system were impossible to ignore. A U.S. economy lumbering under huge debt loads could no longer act as the ever-expanding consumer of last resort for foreign exporters. In the aftermath of the crisis, as the world stumbled through the wreckage, there were hopeful murmurs about the need for a global rebalancing. Export-oriented economies like China and Germany would boost domestic demand to reduce their huge current account surpluses and ease their excessive reliance on foreign buyers. Deficit countries like the US, UK, and peripheral Europe would tighten their belts a bit and orient their economies toward producing more than they consume. The result, proponents argued, would be a more sustainable and equitable world economy for all. Noble goals, but more than a dozen years later, it is clear that this much-needed global rebalancing has not materialized. The trade imbalances and economic distortions that characterized the pre-2008 world economy largely remain with us today. If anything, the problems have only compounded as the world has stumbled from crisis to crisis, a sluggish recovery hampered by fiscal austerity, the European sovereign debt debacle, years of tepid global growth, and more recently, the COVID-19 pandemic and escalating geopolitical tensions. Despite some encouraging signs in the initial post-crisis years, China's current account surplus has proven stubbornly persistent, averaging nearly $300 billion annually over the last decade. Germany, for its part, has run the world's largest current account surplus in absolute terms since 2011, averaging over 7% of GDP. Along with Japan, South Korea, and a number of other East Asian and European economies, they form a bloc of structural surplus countries that have resisted both market and political pressures to rebalance their growth models. The United States, meanwhile, continues to run by far the world's largest current account deficit in absolute terms, nearly $500 billion last year. And its bilateral trade deficit with China remains off the charts, topping $350 billion in 2021, a figure equivalent to roughly half the entire U.S.-China trading relationship. So what explains the persistence of these structural imbalances, in defiance of the textbook economic models, as the heterodox economists see it? The answer lies in the disconnect between comparative advantage theory and the realities of 21st-century globalization. Far from the level playing field envisioned by Ricardo, today's international trade and capital flows take place within a vastly complex web of currencies, tax systems, labor standards, financial networks, and geopolitical power dynamics. In this landscape, they argue, The potential gains from specialization and trade can be swamped by the distortions and imbalances generated when national economic policies diverge too drastically. Take currency manipulation, for example. If a country artificially depresses the value of its currency, as numerous economists have accused China of doing for years, it can make its exports artificially cheap on world markets while making foreign imports prohibitively expensive for its own population. This juices the country's trade surplus and export market share in the short term, but it does so at the cost of global imbalances and simmering resentment among its trading partners. Tax arbitrage is another distortionary force. When countries compete to attract foreign capital and investment by slashing corporate tax rates and offering tax holidays, it can set off a race to the bottom that siphons resources away from public goods like infrastructure, education, and R&D, the building blocks of long-term productivity and comparative advantage. Then there are the issues of labor standards and environmental regulations. If one country allows sweatshop wages, rampant worker exploitation and lax pollution controls while another mandates livable wages, safe working conditions and strict emissions limits, is it any surprise that the former might enjoy a cost advantage over the latter in the global marketplace? But does that advantage stem from genuine economic efficiency, or merely from a willingness to cut corners and ignore negative externalities? To the critics, these distortions and disparities make a mockery of comparative advantage theory. In a world of mobile capital, state-subsidized industries, strategic trade policies, and vast disparities in wages and regulations, they argue, it is naive to expect countries to simply specialize according to their natural strengths and engage in harmonious, mutually beneficial trade. The reality is more akin to a cutthroat struggle for export markets and geopolitical clout, with the most ruthless and interventionist players reaping the spoils. So what does this all mean for the future of globalization and international economic policy? It's a contentious and complex debate, but one thing seems clear: the rose-tinted view of global trade as an unmitigated win-win for all countries, unmoored from considerations of power and politics, is increasingly untenable in today's world. The recognition is dawning, even within the economics establishment, that the course of globalization in recent decades has not been an unadulterated triumph of economic efficiency and comparative advantage. The gains have been real, but so have the costs and dislocations. And those costs have fallen disproportionately on certain communities and segments of society, principally blue-collar workers in developed economies, who have seen their livelihoods upended by the offshoring of industries and the China shock. This is the thorny and treacherous political landscape into which the Biden administration has waded with its recent volley of trade restrictions and industrial policies aimed at China. The package, which includes sweeping export controls on advanced semiconductors, expanded Trump-era tariffs, and hundreds of billions in subsidies and incentives for domestic manufacturers, has been hailed by some as a long-overdue recalibration of America's economic relationship with its superpower rival. Critics, including many of the aforementioned advocates of textbook free trade and comparative advantage, have derided it as a dangerous slide into protectionism and industrial planning. There are risks and downsides to Biden's approach, to be sure. Tariffs are taxes that impose costs on businesses and consumers, and can invite retaliation that hurts American exporters. Industrial policy can be wasteful and inefficient if not well targeted and managed, pitting America against China in a race for technological supremacy and economic autonomy threatens to further sever the trade and financial linkages that have underpinned global growth for decades. But the Biden team's fundamental rationale, that a rising China poses unique economic and geopolitical challenges that cannot be adequately addressed by the laissez-faire trade policies of yesteryear, is compelling. For all the wealth and progress globalization has engendered, it's also true that key pillars of the post-Cold War economic order, from free trade deals to unfettered capital flows to the rote veneration of comparative advantage theory, have become increasingly unmoored from the economic and political realities of the modern world. The core problem is that the institutions and ideologies that have governed the global economy since the end of World War II evolved as a reflection of, and glue for, the era's geopolitical balance of power, namely, America's position as the unrivaled economic, financial, military, and ideological hegemon of the capitalist sphere. But that dominance is now fraying in the face of China's rise, And a new reality is taking shape in which the world's two largest economies are also direct rivals: ideological, military, and territorial. The paradox America faces is that many of the same policies and arrangements that facilitated China's economic ascent, relatively unfettered trade, FDI inflows, and tech transfers, are now accelerating the erosion of the country's own economic and geopolitical supremacy. How to maintain a cooperative and mutually beneficial trading relationship with China while also competing with it and safeguarding America's industrial base and national security? It's a devilishly difficult balance to strike, and there are no easy answers. But at the very least, the present moment demands a clear-eyed reckoning with the limitations and contradictions of the high globalization era, and the ways in which its animating ideas, including comparative advantage theory, have been stretched beyond their reasonable bounds. The Biden administration deserves credit for recognizing that the status quo is untenable, and that reclaiming a measure of economic sovereignty is essential for Americans' long-term prosperity and security. Even if their specific policy prescriptions are imperfect, they are grappling earnestly with the central economic challenge of our time. Ultimately, the path forward will require a pragmatic, clear-eyed balance, one that doesn't reflexively reject the benefits of trade and globalization, but also doesn't treat them as unalloyed and sacrosanct. We must find ways to preserve the immense gains in growth and living standards the global economy has delivered over the past 7 decades, while also ensuring that those gains are sustainable, equitable, and compatible with the strategic imperatives of the 21st century. In this regard, a simplistic invocation of 200-year-old trade theory is unlikely to be of much help. Instead, we will need a more supple and adaptive model of globalization, one that acknowledges the complex interplay between economic efficiency and national interest, and that provides a framework for international cooperation and competition that aligns with the geopolitical realities of the modern world. The work of constructing this new model will be the central project of international economic policy making in the years ahead. We have our work cut out for us.